So welcome to all of you, Shiksha 360. And in this session, basically, we will discuss the overview of chapter number 9, 10, and 12. Clear? That is revision basic, like revision type. So let's start first of all. Our chapter number 9 is that is basically based on the chapter number 9. GDP concept. Clear? Chapter number 9, it is basically based on the GDP concept. Clear? So first point here, which we have to discuss here, what is GDP? Clear? GDP, it is basically gross domestic product. Here GDP stands for basically gross domestic product. Clear? So basically, what is the technical language? This is the full form and technical language. Basically, it is the total market value. Clear? GDP, what? It is the total market value. So here, what is GDP? Basically, it is the total market value of what? Basically, of all final goods and services. Clear? It is the total market value of all final goods and services produced. Very, very important. Clear? Here I will take one word. Produced within the territory of the country. Clear? Produced within the territory. That is whatever will be produced within the territory of that country. That is basically included under the GDP. Clear? That is basically included under the GDP. Clear? So please remember that this point. Clear? Because in the examination they will ask sometimes within the territory, overall, or at all the places. Clear? This type of question they will ask in the examination. So we have to take care regarding this term. Clear? That is within the territory of the country. Okay, within the territory of the country. Next point which we have to discuss here, that is what are the factors of production? Please tell fast, what are the factors of production? What are the factors of production or factors for production? So first of all, how many factors of production are there? Is to be 4 factors. Clear? There are 4 factors. First one is the land, labor, capital. Fourth one is entrepreneurs. Not organization, entrepreneur. Clear? Land, labor, capital, entrepreneur. Clear? These are the 4 factors of the capital of production. Clear? For factors for production. Clear? Factors for the production. These are the 4 factors. Land, labor, capital, and entrepreneur. Clear? And entrepreneur. Clear? Next, we have to discuss another point here. GDP. Calculation of GDP. Calculation of GDP. How many methods to calculate GDP? Clear? How many methods? First of all, we have to discuss how many methods to calculate the GDP. Yes, you are right. There are 3 methods to calculate the GDP. First one is the expenditure wise. Second one is the income wise. Basically, under the income wise, we have factors of production. Clear? Sometimes basically they will ask question. Basically, under which factor? Basically, these are the factors of production. That is under the income wise. Clear? Under the income wise, basically method to calculate GDP, we have 4 factors: land, labor, capital, entrepreneur. Third one is the product wise. Clear? Third one is the product wise. So now under the expenditure method. Clear? Now under the expenditure method, there is one formula to calculate the GDP. Clear? Now under the expenditure method, there is one formula to calculate the GDP. What is that formula? Is equal to GDP is equal to consumption plus gross investment plus government spending plus import minus export. X is export, M is import. Okay. This is the formula under the expenditure method. Clear? This is the formula under the expenditure method for calculate the GDP. C basically stands for the consumption. I basically stands for the gross investment. G basically stands for the government spending. X is export. I is import. Clear? I is import. Clear? So this is the formula for that. Okay. Next one here, that is the income approach. Clear? Basically under the income approach, we have factors. Clear? Under the income approach, we have factors like that is land, labor, capital, and entrepreneur. Clear? So there is one important thing under the income approach. This we have already discussed in detail, these factors. First of all, we will discuss here, that is GDP. at the factor cost. Clear? GDP at the factor cost. Clear? GDP at the factor cost is equal to GDP at the market price. If you have to calculate the market price, in that we have to subtract the indirect taxes. What we have to, this one, indirect taxes minus subsidies. Clear? Indirect taxes minus subsidy. Clear? This is to be also known as GDP at the factor cost is equal to GDP at the market price minus net indirect tax. Net indirect. So net indirect tax, what is that? Indirect tax minus subsidy. Clear? Indirect tax minus subsidy, that is net indirect tax. Clear? Net indirect tax. Okay. So sometimes basically they will ask what is market price. Clear? Market price. Please understand carefully what is market price of any product. Clear? Market price, first of all, we have to include the cost of the raw material, that is factor cost, plus indirect tax which we have to applicable on that, minus subsidy. Clear? Minus subsidy. Please understand this thing. Like we are going to purchase the, we can say that purchase any product from the market. Clear? So factor cost, what is the raw material cost basically for manufacturing that product, plus what is the indirect tax on that which we have to pay, minus subsidy. Clear? If there is any government subsidy on that, we have to subtract it. Clear? Or any other subsidy. So in the net price basically which we have to left, that is a market price. Clear? That is the market price. Same thing they have written here. Clear? Just what they have, GDP at the market price. Sorry, they have to calculate this one, just market price minus indirect taxes plus subsidy. Clear? This thing basically they have to rotate. Just remember this thing. Please tell fast. Now it is clear to all of you basically how we can calculate the market price. This is the raw material cost plus indirect taxes applicable on that, and it is if there is any subsidy, we have to subtract it that. Clear? We have to subtract it that. That is basically GDP at the market price. Clear? GDP at the market price. This one is the concept here. Clear? This one is the concept here. Now move to the next one. There is one more point under that. Net indirect tax we have no. Next one is the domestic GDP, and one more term, that is GNP. Clear? Under the GDP and GNP. Clear? Because there are three terms in the starting of the chapter: GDP, GNP, and GNI. Clear? GNI. Here we have to see that basically this is gross domestic product. This is gross national product. Clear? So here only one term change, that this is national, this is domestic. Clear? So how we can reach to the national? How we can reach to the national from the domestic, that is domestic, plus basically in that how we can go to the national, or that we can overall, that is basically net income. Clear? That is basically net income we are earning from the abroad. Clear? Net income basically we are earning from the abroad. Clear? That is basically known as NFIA. Clear? That is NFIA. Clear? Net factor income from the abroad. Clear? Net factor income from the abroad. And NFIA basically stand basically income from abroad, what we earn from that, minus income to abroad. Clear? What we have to pay to them. Clear? Minus income to abroad. So this is basically NFIA. Clear? This is basically NFIA. Okay. Now next one which we have to discuss here is gross national product or gross domestic product, net national product. Clear? Sometimes basically these types of terms basically they will ask gross domestic product, GDP, gross national product, GNP. We have already discussed that, gross. But sometimes basically they will ask net national product, NNP. Net national product. Clear? So how we can reach to the net? Clear? How we can reach to the net? Basically net, basically we can say that basically how we can reach to the net, basically from the gross minus what we have to do to reach the net. Clear? Basically to reach the net, basically we have to subtract the depreciation. Clear? We have to subtract the depreciation. That is net national product is equal to gross minus depreciation. Clear? Gross minus a depreciation. In this way basically we will reach to that. Clear? In this way we will reach to that. Clear? So I have write here some formulas here. Please understand. GDP basically stands for the gross. Please remember, you will find question on the basis of that. Gross domestic product. Next one is GNP. If they have given GDP, clear? If they have given GDP, so how we can calculate the GNP? Clear? GNP is equal to GDP. This is G same, this is G same, P same, P same. So how we can go to the national from the domestic? We have to add NFIA. Clear? We have to add NFIA. Clear? NFIA, that is net factor income from the abroad. Okay. Next we have to do NDP, net domestic product. Clear? Net domestic product, that is GDP minus net domestic product. Clear? Net domestic product, that is basically net domestic same product same, domestic same product same. So basically how we can get net? That is basically we have to subtract depreciation. Just remember these basic things so that you are able to understand. Okay. Next thing which we have to understand is net national product. Clear? Net national product, if we have given GDP. So first of all, product is same, product is same. For national, how we can go to the national? We have to add NFIA. And for the debt, we have to subtract the depreciation. Okay. Just same things they have given. We have to formulate the things. Clear? We have to formulate the things on the basis of that. Clear? We have to formulate the things on the basis of that. Clear? We know that GDP plus NFIA. Clear? Sometimes basically they will give directly GNP. To calculate the NNP, they have directly give GNP. Clear? So we know that this one is GNP. Clear? So NNP is equal to GNP minus depreciation. Clear? GDP plus NFIA. Okay. And sometimes basically they have given NDP. So GDP minus depreciation. So NNP is also equal to NDP plus NFIA. Okay. So in any way, they will give you the question. Clear? In any way, basically they will give you the question. What one thing basically I will tell you, please focus to the basics. Clear? Please focus to the basics so that you are able to understand all these things. Clear? So that you are able to understand all these things. Any other doubt, any other query from this point? Okay. Now move to the next one. Yes, in all the points, just please remember that in all the points, GDP is the base. And you have to remember that how we can calculate the net gross minus depreciation, how we can calculate the national domestic plus NFI. These two things plus these two formulas are the base of all these things. Clear? Are the base of all these things. If you are able to concentrate on these 2 points, definitely you are able to answer the question. Clear? Whatever they will ask question on that in the examination, you will be able to answer the question without any issue. Hope it is clear to all of you regarding these formulas. Clear? Now we have to discuss some other things. Other things basically regarding to the chapter number 10. Clear? Chapter number 10. In that, there is not any typical thing under the chapter number 10. Chapter number 10 is union budget. Clear? Chapter number 10, it is basically based on the union budget, and under that, clear, under the union budget, sometimes basically they will ask basic question on that. Basically, what is the date of presentation of the budget? Clear? That is last working day of the Friday. Clear? Earlier it is last working day. Presently it is 1st of February. Clear? Presently it is 1st of February. Okay. Earlier it is last working day. Presently it is 1st of February. Clear? First working day of the February, or we can say that 1st of February. Clear? In most of the case it is 1st of February. Clear? Earlier basically rail budget is to be presented separately, but I think after 2017 or 2016, clear, it has to be merged with the general budget. Clear? It has to be merged with the general budget. I think in the year 2017. Clear? It has to be merged with the general budget, and budget is to be represented by the finance minister. Clear? Budget is to be represented by the finance minister. Clear? Budget is to be represented by the finance minister. Okay. So now further, there are some terms basically in the budget, that is revenue, and expenditure. Sorry, revenue, that is revenue shift. Either it is to be revenue shift or it is to be revenue expenditure. Similarly, under the capital receipt, capital expenditure. Okay, so capital basically what it tells that clear. Basically, capital basically what it tells that basically it tells us the establishment of any new things. Clear, establishment of any new infrastructure. Okay, revenue means basically for the daily going business. Clear, for the daily going business, that is basically revenue expenditure or revenue sheet. Clear, basically revenue sheet, like basically we are earning from the taxes. Clear, we are earning from the taxes. Clear, all these things basically come under the revenue sheets. Clear, so let's discuss some of the important things under that. So what is here? What are the revenue sheets? Clear, what are the revenue sheets? Basically earnings. What are the revenue sheets? Basically earnings made by the government. Clear, revenue sheets basically earnings made by the government which neither creates, clear, which neither creates liabilities nor reduce assets of the government. Clear, which neither creates liabilities nor reduce assets of the government. Clear, that is basically known as the revenue sheets. Clear, please remember this thing. Clear, that is the earning made by the government which neither creates liabilities nor reduce assets of the government. Example, like receipts from the tax collection, dividend earning, like this year government basically earned dividend from the many public sector banks. This is also the revenue sheet. Clear, interest on the investments, clear, all are comes under the revenue sheets. Clear, all are comes under the revenue sheets. Clear. Now second one, that is capital receipt. Clear, second one here, that is capital receipt. Clear, what is capital receipt? Basically, please remember this carefully, that is earnings made by the government. Clear, capital receipt, that is earnings made by the government which creates liabilities. Clear, that is earnings made by the government which creates liabilities. Clear, basically capital receipt, that is basically which creates liabilities. So how basically it creates, like we can say that borrowing funds from the public. Can anyone tell basically in the form of borrowing funds from the public in the form of PPF, small deposit scheme, clear, or other government schemes, national pension scheme, NPS, etc. Clear, that all are comes under the capital receipt. Clear, basically that all are comes under the capital receipt. Clear, basically that is earnings made by the government which creates liabilities. Clear, basically which creates liabilities. Second point under the same. Clear, second point under the same, that is or reduce assets. How we can basically government reduce assets under the capital receipt? That is by doing the disinvestment. Clear, by doing the disinvestment. Clear, by doing the disinvestment. Clear, that is basically it reduces the assets. Clear, it reduces the assets. Now another point which we have to here discuss is, we have discussed already here, revenue receipt, capital receipt. Next point which we have to discuss now, that is revenue expenditure. After that, capital expenditure. Clear, first is revenue expenditure. Clear, revenue expenditure, that is basically expenditure by the government. Clear, this is basically expenditure by the government, expenditure by the government on recurring basis. Clear, on recurring basis. Clear, expenditure by the government on the recurring basis, such as example, Administrative expenses. Administrative expenses, interest payments on the loans. Clear, all these are, or pensions, subsidies. Clear, all these things are basically comes under the revenue expenditure, pensions, loans. Now only one thing we have left, that is capital expenditure. Capital expenditure. Clear, capital expenditure. Clear. So what is capital expenditure? That is basically the expenditure used. It is a productive. Clear, it is a productive asset creating. Clear, it is a productive asset creating long period. It is a productive asset creating. Please remember all these words. Productive asset creating. We have to create an asset. Basically, that asset to be created with a long period, like we can say that any bridge or any institution, long period. Non-recurring. Clear, non-recurring expenditure of the government. Clear, non-recurring expenditure of the government. Clear, non-recurring expenditure of the government. Like example, roads, dams. Clear, all these things basically are comes under the capital expenditure. Clear. So we have discussed four things: revenue receipts, capital receipts, revenue expenditure, and capital expenditure. Clear. Now next thing which we have to discuss here, that is fiscal deficit. Fiscal deficit. So what is fiscal deficit? Clear. Basically fiscal deficit, it is the difference. It is the difference between the total revenue. Clear. Fiscal deficit, basically it is the difference between the total revenue and total expenditure of the government. Clear. What is fiscal deficit? Basically it is the difference between the total revenue and total expenditure of the government. Clear. That is basically fiscal deficit. Clear. What is the meaning of fiscal? That is yearly. Clear. Here what is the meaning of fiscal? That is yearly. Clear. And deficit, what is the meaning of deficit? That is shortfall. Clear. That is a shortfall. Shortfall basically of what? That is cash inflows and outflows. Clear. Shortfall basically in which form? Cash inflows and outflows. Clear. So when this shortfall occurs, clear, basically when this shortfall occurs, basically this shortfall occurs basically when government expenditure increases or exceeds. Clear. Basically when government expenditure increases or exceeds the total revenue. Clear. Basically increases or exceeds the total revenue that it generates. Clear. The total revenue basically that the government generates, except money from borrowings. Clear. Except money from borrowings. Clear. Money from borrowings are not included under that. Clear. Except money from borrowings basically are not included that. Clear. Basically, so when shortfall will occur, basically when the government expenditure increases or exceeds the total revenue that it generates, basically except money from the borrowings. Clear. Except money from the borrowings. Clear. So basically how we can represent the fiscal deficit? Fiscal deficit basically total expenditure minus total receipts, excluding borrowings. In this way, basically they will ask the form of the question. Second way, fiscal deficit, FD, total expenditure minus revenue receipt minus capital receipt, excluding borrowings. Clear. So this is the fiscal deficit. Clear. So this is the fiscal deficit. Clear. Sometimes basically they will ask when the fiscal deficit will become zero. Clear. When the fiscal deficit will become zero. Clear. When the fiscal deficit will become zero. If we add if when the fiscal deficit will become zero. When basically if we add borrowings, clear, basically if we add borrowings in the total receipts, clear, basically if we add borrowings in the total receipts, the fiscal deficit will become zero. Clear, in that case fiscal deficit will become zero. Clear, if we add borrowings in the total receipts, the fiscal deficit will become zero. Clear, the fiscal deficit will become zero. Clear, that is the overall discussion of the fiscal deficit. Now move to the next one, that is revenue deficit. Clear, now next one which we have to discuss here, that is revenue deficit. Clear, basically what is the meaning of the revenue deficit? Basically when there is, basically it is a difference or there is excess of total expenditure over its total revenue receipts. Clear, over its total revenue receipts. Clear, so basically when there is more expenditure, clear, than the revenue, that is basically known as the revenue receipt. Clear, that is basically known as the revenue receipt. We just in the form of simple language we can say that total revenue expenditure minus total revenue receipt. Okay, so what it means that, clear, what it means that technically what it means that basically it means that, or it signifies that the government on earning, clear, government on earning is insufficient. Clear, that the government on earning is insufficient to meet the normal functioning. Clear, to meet the normal functioning of the government department. Clear, of the government department. Okay, now next one, clear, now next one, that is basically one another term which we have to discuss here, that is primary deficit. Clear, next term which we have to discuss here, that is primary deficit. Clear, what is primary deficit? It is equal to the fiscal deficit minus interest payments. Clear, fiscal deficit minus interest payments, that is the primary deficit. Clear, basically fiscal deficit minus interest payments, that is the primary deficit. Clear, so one thing basically, please go through the deficit. Please go through the definition. Basically what is primary deficit? Basically it is defined as fiscal deficit of the current year. Here, fiscal deficit of the current year. Here what is fiscal deficit? Basically it's fiscal deficit of the current year minus interest payment. Clear, IP, basically interest payment on previous borrowings. Clear, interest payment on previous borrowings. Clear, so please remember this is the exact formula, that is fiscal deficit of the current year minus interest payment on the previous borrowings. Clear, minus interest payments on the previous borrowings. Clear, this is the formula for that. That is primary deficit is equal to fiscal deficit minus interest payment. Okay, so this is the overall discussion of the fiscal deficit, revenue deficit, and primary deficit. Clear, now one thing basically sometimes basically you will find in examination, basically CAD. What is the full form of the CAD? Can anyone tell? Basically CAD basically stands for the current account deficit. CAD basically stands for the current account deficit. Clear, sometimes basically you will get questions or you will read at some place regarding the current account deficit. Clear, basically what is the current account deficit? Basically it is a measure. Clear, it is a measurement. It is a measurement of the country state. Clear, what is current account deficit? That is, it is a measurement of the country state in which the value of goods, clear, in which the value of goods and services, clear, basically in which the value of the goods and services which we have import. Clear, import, that is basically we have taken from the other countries. Clear, import, that is basically we have taken from the other, that is basically when it exceeds. Clear, exceeds the exceeds the value of goods and services. Clear, exceeds the value of goods and services exported. Clear, exceeds the value of goods and services exported. Clear, exceeds the value of goods and services exported. Clear. And what is the main? Which of the following basically it is the main role played under that? That is basically we can say that example like crude oil. Crude oil. Clear, basically India majority imports the crude oil. Clear, basically this is also one of the main reason under the current account deficit, that is the crude oil. Clear, basically India imports a major portion of the requirement of its crude oil in the as it imports. Clear. And second one like that is gold also, gold import also. Clear, because the highest consumption of the gold basically in the world, it is in India. Clear, it is in India. Clear. And there is domestic production of the gold is negligible in the India. Clear. So these are the two main points, crude oil and the gold. Clear, basically which is the main reason behind the current account deficit. Clear, which is the main reason behind the current account deficit. Okay. So some more different formulas we have to discuss regarding the chapter number 12. Only 3 to 4 formulas I will discuss now. Chapter number 12, that is time value of money. Clear, that is time value of money. So very, very important and very easy formula. Most of the question where you are not able to understand anything, just try to implement this formula, that is future value. Future value is equal to present value into 1 plus r power n. Clear, future value is equal to present value into 1 plus r power n. Clear. And if they are asked, that is semi-annually or half yearly. So what do you have to do? Just write it same formula. Now R, rate of interest, ROI becomes original R by 2. Time becomes original time and into 2. Clear, just we have to double. If they have quarterly, ROI becomes original R by 4. Time becomes original time into 4. Okay, and or we can say that. Okay, so these are the different notations which we have to use. Clear, which we have to use in the examination point. Clear, at the time of the examination, just we have to remember these basic things so that you are able to answer the question. Clear, so that you are able to answer the question. Now next one thing more basically, which they will ask in the examination, that is rule of 72. Sometimes basically we are not able to understand basically how to solve the question. Sometimes basically they are given basically in how many years the amount is to be double. Clear. So sometimes basically we will forget get that rule of 72. Clear. What the rule of 72 says? That rule of 72 basically the time taken for any amount to be double, that is 72 upon rate of interest. Clear, 72 upon rate of interest, that is it becomes the time for double any amount. Clear, it becomes the time for basically double any amount. Okay, now next thing which we have, one point I will discuss for, what is compounding, what is discounting. Compounding and discounting. Clear, you will get 1 mark question. What is compounding? That is basically present value. Compounding and discounting. Clear, this one is the form of the definition. Clear, this one is the form of the definition you will find in the examination. Clear, what is compounding and what is a discounting. Clear. So what is that? First of all, we will discuss discounting it. Clear. Basically discounting, it is a cash flow. It is a cash flow. And what it tells basically, in the case of discounting, we know that the future value and we will move towards the present value. Clear. Basically we will know the future value and we will move towards the present value. And in the compounding, clear, in the compounding we will know that the present value and we will move towards the future value. Clear. Just you have to remember that in the case of compounding, we will on left hand side we will take future value, and on the right hand side basically this one, present value into 1 plus r power n. Clear. We have to calculate the future value, compounding. And in that case of discounting, we have to kept with the present value on the left hand side, future value upon 1 plus r. Clear. But just please remember these things so that you are able to answer the question in the examination. Clear. So that you are able to answer the question in the examination. Next, one more point, that is effective interest rate. effective interest rate. What is the formula for that? 1 plus r by n power n minus 1. Clear? This is the formula of the effective interest rate, basically where n is basically number of the compounding periods. Clear? Number of the compounding periods. Like in the case of quarterly, it is to be 4. Clear? It is to be 4. Or in the case of monthly, it is to be 12. Clear? It depends upon case to case what they have given. And one more thing, basically, as the compounding becomes continuous. Clear? As the compounding becomes continuous, what is the effective interest rate? Clear? As the compounding becomes continuous, what is the effective interest rate? In that case, effective interest rate is equal to e power r minus 1. Clear? E power r minus 1. Basically, here e is to be the exponential number. Clear? Here e is to be the exponential number. Clear? So in this session, we have to discuss up to this much point. We will discuss some important things regarding the chapter number 11, 12, time value of money, basic formulas, chapter number 10, primary deficit, revenue deficit, fiscal deficit, what is revenue expenditure, capital expenditure, revenue capital receipts, union budget, some important things. And after in the chapter number 9, that is GDP concept, we will discuss regarding the GDP, GNP, NDP, and NP, how we have to formulate the formulas, what is a calculation of the GDP, what are the different ways, 3 methods, expenditure, income wise, product wise, and under which basically there are 4 factors of production, basically under the income wise, land, labor, capital expenditure. Clear? Land, labor, capital expenditure. Clear? So we will take one more session. I will update in the group, so that is of module C. Clear? So thanks to all of you for joining this session.